Well, JSPL has reported in line with the street estimate numbers for the March quarter. The company has reported a 14% decline in the EBITDA performance and a colossal loss of more than 2,000 crore for this quarter, mainly on account of the exceptional item. But to further explain these numbers, we've been joined by the management of the company, Mr. Ansari here, the managing director. Hello and welcome to Bloomberg Quint, sir. Let's start off with the steel division first. We've seen a 5% decline year-on-year basis for the quarter gone by, and also a growth of more than 50% for your steel division. Now, my question to you is, what can we expect going forward in FY20? Why have we seen this decline? And what are the cost inflationary pressures right now that the division is facing?
So, before I respond to that specific question, let me also add that this year, this is also an end of financial year, and we think that this financial year has been really very good. In this financial year compared to last year, we have increased our revenue by 58% and our EBITDA by 51% on a standalone basis. And on a consolidated basis, the revenue has gone up by 40% and the EBITDA has gone up by 30%. So all in all, we do believe that it was a good year. As far as the last quarter is concerned, you are right that the EBITDA per ton numbers have come down, and the reason for that is that the NSR, the prices had actually come down in the market. So the price pressure was close to about 2,800 rupees per ton. Part of it, close to about 1,200 rupees, we were able to cover up by our own cost improvement plans. So we were able to contain our cost, and that contributed to 1,200 rupees positively. So therefore, but the rest of it obviously led to a reduction in EBITDA per ton compared to the earlier quarter. So that is point number one. Number two is that going forward, I mean, you asked this question that how we really look at it. Going forward, there are a few positives which we really look at. Point number one is that this the liquidity issue which is currently facing this industry and the business in India, close to about shortage of 1.5 lakh crores of rupee, which is not really, the liquidity is not there. We expect that as soon as the new government takes over, they would address this issue very, very quickly. And once that happens, all the latent demand, please understand that the demand in India is still quite good, with the kind of GDP growth we have, 7.5%. The steel demand is also 6.5–7% year on year. So with that demand, it is just that once the liquidity problem is solved, then more and more orders will be available in the market at the right kind of price. Now, the other thing which is also there is, as far as the steel prices are concerned, because the iron ore prices internationally have gone up substantially because the Brazilian supply issue, there are some concerns related to that. So therefore, the prices have shot up quite sharply in the recent week. And so that should certainly lead to increase in international steel prices. Now, that international steel price increase should also have a positive impact on the Indian steel prices. And as far as Indian iron ore prices are concerned, if you look at the correlation between Indian iron ore price vis-a-vis the index, the international price is concerned, last year you will find that for most of the period when the international index was at $65 to $70, the Indian iron ore prices still had doubled and so on. So the correlation is not really that strong at all. So we expect the iron ore prices to remain at the same level. In fact, we would expect going forward they should marginally come down because they had recently increased by 200 rupees. That is under negotiation. We do expect that it will marginally come down. So all in all, what we are saying is iron ore prices in India should remain stable. The steel prices should go up on the back of better liquidity availability as well as the better international prices which are likely to happen. And then on top of it, we are doing our own bit in terms of cost reduction. In Angul, we still have a large headroom available for our cost reduction which is there. We are working on it in the blast furnace area, in the mills area, in the yield. Everywhere we are working, very substantial work is going on. That impact should be at least 1,000 rupees in the coming quarter, or in this quarter and the coming quarter. And on top of it, we are also working on our value added rate. So currently we are already at 62% value added rate.
Sure.
And with the rail orders which are more and more rail orders which are going to come, we should really be improving on that. So all in all, I think it will be a much better year here.
All right, in that case, sir, what is the operational performance growth that we can look at, and also the sales volume growth for FY20? In this year, we did a 50% plus kind of growth for FY19 in terms of operational performance. Are we looking at a number northward to that? Also, if you could put a number to the volumes figure, growth figure going forward in FY20?
Absolutely. So, if you look at the quarter growth, I mean, we did close to about 1.5 million ton and 1.51 actually in this particular quarter on a standalone basis, which is almost more than 6 million ton exit rate. To the market, we have already said earlier that this in 2020 we should be doing about 6.5 million ton. We are absolutely sure that we will not only do up to 6.5, we will beat it easily. We should be somewhere closer to 7 million ton, but we are still, as far as market is concerned, we are maintaining that number of 6.5. And internationally, that means in Oman, we should be doing close to about 2.2 million ton. So altogether, between domestic and Oman operation, we should be somewhere close to about 9 million ton. This last year we did a little less than 8 million tons. So there will be a substantial jump as far as the production is concerned, and therefore, and also as I said that NSR in this particular year we expect to be much better. So all in all, we expect positive results coming because of these two factors.
Mr. Ansari, just a follow up to that question, what's the steel price that you're looking at by the end of this year? And also, if you could put a number down to the iron ore prices currently, since you expect them to remain around the same level by the end of this year or the financial year?
So you see, I mean, as I said, that there are three aspects. One was the liquidity and as well as the international prices. It's not easy to guess what will be the price by the end of the year, but my gut feel is, based on our past understanding, is that these prices should be at least 3,000 to 4,000 rupees more compared to what it is. So that is my expectation would be by the end of the year, the steel prices should be at least up by that much, if not more. So that will be close to about 7 to 8% price increase which is there. That's the way I look at it. And as far as iron ore prices are concerned, domestically we would expect that these prices are already at high level. See, India has one advantage, that's of iron ore, and already domestic prices are high, so we would not expect it to go any more than this.
All right. Also talking about a little bit about the power division as a whole, we've seen a flat performance coming in the Q4, and it is down by as much as 19%, completely for the financial year on operational basis. I'd like to understand what can we expect now going forward for FY20 on the operational front, and also if you could give us a PLF guidance for that division.
So the good thing is that we see some PPAs on the horizon. So you are aware that recently we had also won more than 500 megawatt PPAs from PFC, and that of course is yet to be kind of finally signed on and to be operational. So that will take a little while. Maybe the earliest it will start will be somewhere around September, October or so. There are additional PPAs which are on the horizon. Bengal as well as Gujarat, there are both are likely to be in the market, and the offers are expected to be made by end of June or so. So therefore these are the ones which will impact in the later part of the year. Now as far as immediate is concerned, we expect because it is already summer, the demand for the power is high. So therefore, whatever is there in that exchange, that's something which we are pushing as much as possible. And but of course, the actual benefits will start accruing only towards later part of this year, once more and more PPAs are available. So we certainly expect that substantial amount of PPAs should be there, and our PLF should go up much more, maybe somewhere closer to about 60% or so, or maybe more.
All right, so talking a little bit about the Oman division as a whole, the EBITDA was down by more than 45% year-on-year basis. I'd like to understand the decline behind, the reason behind the decline of this operational performance of this division, and also the outlook for this division going forward. Besides that, I would also want to understand the deleveraging plans for this division.
So as far as Oman operation is concerned, they are doing very well. The mill has produced, last year they have produced, I think, 18% more than the earlier year. So that's overall a very good performance. What has happened in Oman and in that market, which includes UAE and the nearby market, is that the demand for rebar has come down quite a bit, and the supplies are still high. The other issue also has been that some material was finding its way into that market from Iran in terms of very cheap billets. So therefore, there are a number of re-rollers who had actually started, operating. Those who had already closed down, they had restarted because cheap billets were available. So as a result, there was huge pressure on the prices. The supply was more and the demand was less, and also cheaper billets were available to some of these re-rollers. Now all that, there is a lot of tightening of the system which is really happening. So in the times to come, we should really see some improvement out there. But the fact is that in that part, the demand has come down a little bit. So as far as Oman plant is concerned, in order to improve the profitability, there are other alternative product mix which are being talked about and already worked on. So one of the important thing which we have been doing is rounds, which we are supplying for seamless pipe, etc., which still gives us good margin. So we are pushing up production for that. More and more supplies and more new markets are being looked for that, and also for special grade billets which are still having good margins. So those are the ones where we are working more and more. And then of course export of the rebar is another area which is there. So there are several steps which are being taken in Oman to improve the profitability, but of course that market has become a little more difficult, and that immediate market, it will take a little while before it actually improves, because a lot of it depends on what is the oil price which is there. They are very sensitive to the oil price, and if the oil price improves, then this demand should likely to improve. Now one more thing I would like to say, because of this Iran sanctions, it is possible that the oil prices will actually go up, and if the oil prices go up, then it is a good news for Oman business. Maybe not so much for India per se, but for Oman business it's a good news, and then they can actually improve their demand as well as the EBITDA margin out there.
All right, in that case, I'd like to understand what is the improvement in profitability that you're expecting from your Oman division going forward in FY20 with the slew of measures that the company is undertaking right now. And apart from that, even if oil behaves in the way that the company, which is favorable for the business, what's the kind of uptick do you see in terms of profitability for that division?
So we did, as far as last year is concerned, as far as Oman is concerned, we had somewhere close to about $180 million of EBITDA. We would expect that we will be able to maintain that and actually maybe try and make some improvement based on our product mix. So somewhere between $180 to $200 million is something which we are fairly sure that we should be able to do that. And you also had asked about this question of deleveraging in Oman. So there's a lot of work which has already been done. This work is in a matured state as of now, but obviously since the market has gone down, it is taking longer. We think that in 1.5 to 2 months we should be able to come to some conclusion on this matter.
Sure, that's a good news. In that case, sir, talking about your net debt to EBITDA level as a whole by the end of FY19 stood at 4.6 times, which is a great improvement from the kind of 6.6 times level that we saw in March 2018. But now I'd like to understand what's the target that we can expect going forward in FY20, sir.
So on a consolidated basis, our expectation would be it will be just about 3 or little over 3 on a consol basis. As far as standalone basis is concerned, we expect it to come down to 2. So that will be a great improvement compared to where we were last year or before that, you would see a very, very substantial drop in our debt to I mentioned about that, debt to EBITDA ratio. So debt to EBITDA ratio should actually the numbers which I mentioned was more for debt to EBITDA ratio. So it should certainly improve that substantially.
All right, sir, we get your point clearly there. 3 times is the number that we can look forward in FY20. It was clearly great speaking to you as always. Thank you so much for taking out the time to speak to Bloomberg Quint, sir.
Thank you very much.